What's up, investors? This is just a video that is supposed to accompany my thoughts about the account update. It is December 17th, and I have a few topics to discuss in light of my recent losses about Smith & Wesson. So I have a little outline here that I'm going to refer to. First one is, I was listening to a show about investing, and there was a story about a fund manager that was trying to train his traders that it's really easy to take a loss, and there's no like shame about it. Like, if you make a bad trade, you should just own up to it and continue, wash your hands out of that trade and start fresh. So there's something to be said about that. But on the other side of the argument, there is the investment mentality of holding strong when things go tough. So that is to be explored a little bit later. A second, recession, but how much is priced in? So that goes into the first topic. Whenever you are presented with a opportunity to take a loss, we don't know how far down. Like, we all know that things are going to go bad, but markets don't necessarily correlate with what's going on in the economy. Sometimes all of the bad news might be priced in. We don't know how much is priced in already into the markets. So just because someone predicts a recession, let's say we all know there's going to be a recession and just 100% chance, we still don't know if the market's going to keep going down or not. Also, I don't know how much the current stock that I'm holding is correlated to that macro outlook. So it's not that useful to base everything on macro events that you think may or may not happen. So nobody has a perfect track record of predicting it except perhaps the inverted yield curve. And we could be proven this time around that it could be false. So we don't know, because everybody knows that the inverted yield curve predicts recessions, and therefore everyone's positioning. So the market's already come off like a 20% or so. So we don't know if that's enough for the recession or it's going to drop more. We don't know how deep that recession is going to be, if it comes at all. So, I mean, it's pretty certain that it'll come, but still, like, again, we don't know how much is priced in. Next, at what point is it clear that it's a loss? So this is a difficult one, right? So that's something I'm working on right now. So I have a few criteria on the current position for Smith & Wesson that I'm going to exit if X and Y and Z happens. One of the things that happened with Smith & Wesson is that they've been burning through cash a lot, and it's one of the reasons why I got into the stock in the first place, because they had a huge cash reserve, which values the business at a lot lower. Like, they had 70 million in cash or so, but they've burned through that now. They're left with about 5 billion of cash, net cash. And so it's difficult to kind of figure out, okay, like, is my thesis of coming into the stock in the first place still there? And if that's absent, then what's left? There are quite a few things still left. Number one, the history of the stock and how it's been alive for, since the 1800s. It doesn't mean it can't go bust, but I'm just saying there's a history of this company being profitable, even with quite a few headwinds. I mean, it survived through the great financial crisis, right? Yes, the stock price is volatile, but I think that it's near the bottom of its range now. Maybe it could drop to like the 5s, and that would be really unfortunate. I've already lost about $37,000 on the stock of unrealized losses. So it could drop another, 30. So far, the decision is that I'm going to stay with it, and I'm going to keep paying the interest rate on the debt that I've accumulated because of the stock. And I may use other stock to offset some of that loss. It could prove to be a bad decision come January or February, but we'll see. I want to at least wait one more earnings report to figure out exactly what the management is planning to do with the stock, whether they're finished with the move already, how much more outlays it's going to require, and how their investments are looking, and when they're going to start cranking and use the profits to return earnings to shareholders. Now, they're still doing that in the form of dividends, but I don't want them to go in debt just to pay the dividend. It doesn't make much sense to me. So if they had excess cash, then it would make more sense. But if they don't, you might as well not do it. Position scaling and conviction. So those two are basically inversely related. The less conviction you have in a position, the more diversified you should be or you are going to be. For example, if somebody doesn't know anything about investment, the best thing for you to do is to invest in an index like the S&P 500 or the Dow or the Wilshire 5000 or something like that, where you just have an intersection of all the businesses that are publicly listed in the States, or at least based in the States, American companies. And you don't have to worry about one or two or five or even 100 companies going bust because you are so well diversified. Your portfolio is barely going to feel it. But the more you narrow that down, the more there needs to be conviction in your picks. Like if you're 100% convinced that Tesla is going to be, next biggest company in the world, I think the bulls in Tesla are a lot less now than they were last year. But regardless, you put all your eggs in that basket, at least all your investable cash in that basket. Your conviction must be really high, right? You must be 100% convinced that's going to happen. If not, you're going to scale back. Maybe you buy some other stocks. Maybe you buy some S&P 500 indexes along with your Tesla position or some bonds or what have you, or stay in cash. So you see how the conviction and diversification inversely relate to each other. Now, when it comes to Smith and Wesson, apparently my conviction is pretty high, and it was pretty high because I know that this business is going to survive. It's just, what is it going to be valued at for a long time? That's the bigger question. Like, yeah, it's going to be survive for the next 10 years, but is it going to be valued around the $2-3 per share range? Like, is it going to be a $200 million market cap company, or is it going to be a $1 billion market cap company? So it's really difficult to say. If I get a chance, if there's a good earnings report, a good like holiday shopping season, and the stock goes up to 12.5, I have, I'm either going to sell call options on it or I'm going to exit the position altogether. If it shows very promising figures and prospect for growth and cash accumulation, then I might actually keep the company. But when it comes to the downside, I personally still need to figure out, like I mentioned earlier, I need to figure out exactly the criteria, and I suggest other people do this too. The criteria at which you're going to scale out or completely pull out of the position. Write them down on a piece of paper, and then follow suit. All right, so let's say it's a price thing. So if the price of the company drops to a certain level, maybe you say, okay, I'm going to reduce my position by 30% or 50% or what have you. And that's the plan, and you got to stick to it. Now, I personally, at the moment have a very fuzzy bottom line, so that's not good, right? That's not good, especially if position that's high. And it's a big percent of the account. So I'm very confident that the company will survive, but still I should have some contingencies. And I have, one of the pillars that got me invested into companies going, which is the cash position. So now if the profitability gets hit, that's the other pillar. And then, if the management shows signs of cracking and not controlling the company very well, that's yet another pillar. So now I'll be basically forced by my own criteria to exit a position. Now this is kind of vague, so I need to actually be more specific and write things down on paper. Maybe market capitalization should be one of those things. Like if a company drops below a certain price and I can't take it anymore, that's going to be $100,000 lost, right? If the company goes below, let's say 100 million market cap, which I don't think will happen, but let's say it does, that's going to be a lot of money to pay back through the other investments over time. So I'm still debating whether I should put that criteria in there or not. Let me know what you think about the issue. Like, do you have basically stop loss on your investment? I understand as a trader it's very common to do, and it makes sense to control the risk and take an L and diversify and all that. But when it comes to investing in a company that you've researched well and things don't go your way, do you have a price target that basically you cut your losses at and reinvest? I know some of you commented very nicely in other videos that you do have and have experienced that and have gone to a clean slate, and then things start look up after that and feels fresh. But I'm wondering, like, did you think about that and in the beginning before you enter the position? Like, what kind of process do you guys have about entering and exiting the position? Is it a scaling in and scaling out method, or is it like a clean cut once it reaches a certain point, stop loss, cold turkey, get out of the position? So what kind of methods are there that you're using to manage and execute your position size, risk tolerance, and maneuverability, like mobility when it comes to your portfolio? All right, let me know. Also, let me know if this is a good idea, kind of splitting up the videos and doing one portfolio update and then one just my thoughts on that day when it comes to investing and all that. If you'd rather hear one or the other, or both in one video, or two separate videos like this is just fine to let people pick. So let me know about that. I'm really curious. I'm mainly doing this for myself to kind of keep a video log of my emotions and my mental state during specific times in the market, like this one especially. But if I'm putting this out there and being public about it, I want to know what people would like to prefer to hear. If you're listening to what I have to say, what kind of format you prefer to hear it in. All right, so let me know in the comments. I'll be checking them out. Thanks. Peace out.